Are you ready?
I'm ready. You ready?
All right. Oh yeah, there's shit on the table. Where's your cup? Oh, you're advertising for JDRF. That's what it is.
You know,
That's
I'd like
how
to
it
be
is.
an equal opportunity advertiser.
Okay. We're good. Okay,
There.
doesn't say Sigman.
I don't have. Well, you don't have your cup either. Who are you? Why are you repping Texas?
Because I'm Texan. I'm Josh Sigman, and I'm a mortgage lender. I'm also a geek for money, not just earning it and saving it, but literally everything about it. I love that money has rules. It has its truths. I love investment strategies, and I love making money work for us. For so many, money is emotional. For me, it's logical, like a puzzle. My passion is also helping others with their money. I love looking at people's finances, dissecting their puzzle, and rebuilding with strategy and purpose, and I'm really good at it. I'm making this podcast about my money strategies, not the things that are written in books or sold in programs. It's a podcast outlining the lessons I've learned and used for the past 15 years. These strategies help me and those who use them save more, give more, create wealth, and retire early. Let me teach you how to build your net worth. You ready? Welcome to Sigman Sense. Okay, here we go. Back for another episode of Sigman Sense. We're going to talk about when can I spend all this money I've been saving. So that's going to be the topic for the day. We also want to cover a couple of questions that came in.
Yeah.
So we'll take a few minutes to do that. What was the email address that we're advertising now?
So if you have questions that you want us to answer specifically, the email address is sigmansense@gmail.com. And we will answer your question in an email, and then we will talk about it in an episode. Once we do that, you'll get an early access link to the episode for you to listen to and also share with your people.
Peeps.
Share with your network.
Cool.
So
What was the question?
One of the questions that has come in is, what is the difference between homeowners insurance and a home warranty? And do you need them both?
Okay.
And then I think it's worth going into talking about mortgage insurance because
Got it. Okay.
So
Do you know who asked that question? Or we not?
Teresa Perez.
Hi, Teresa.
Yeah.
Thanks for watching. We'll just spend 3-4 minutes on this before we go into our normal episode. So, yes, they are all very different. So we're talking about home warranties, home insurance, which is called hazard insurance, and then also mortgage insurance. And so they all cover different things. And so here's the bottom line. So let's start with mortgage insurance first. Mortgage insurance protects the lender. It doesn't protect you. It is expensive, depending on the year for tax write-offs, depending on if you have enough or not. Some years you can write mortgage insurance off. Some years you cannot. That kind of changes over the decades. But what mortgage insurance is primarily for, what the purpose is it allows buyers to put less money down.
Okay.
That's what mortgage insurance is for. So if you go back 100 years and, granddaddy wanted to buy a house or buy something, he had to put money into it. And, you think in terms of the standard 20% down kind of rule of thumb. Not everyone has 20% to put down, right? Especially this day and age. In fact, most people don't have the ability to do 20% down for the first home. And so when you have less than 20% down, there is a heightened amount of risk for the bank.
Okay.
Because if you did foreclose, the cost to market, sell, foreclose, have attorney's fees, courthouse stuff, all that stuff, exceeds 20% or it gets up to about 20%. And so the reason why if you put 20% down, you don't have to have mortgage insurance is because if you put 20% down a house and then you screwed up and lost it and it was foreclosed upon, the bank has a reasonable chance of getting their money back out of it. Okay. So people that want to put down 3, 5, 10% down, that's awesome. And I would encourage people to do that because if the monthly payments within their budget, it's a great way to get things started and leverage money. But that mortgage insurance is there and it has different rules depending on different loan types. So on a conventional loan, there's a couple ways it's handled. The more you've got down, the less the mortgage insurance is. So 5% down is more mortgage insurance than 10% down, which is more mortgage insurance than 15% down is.
Right.
It does go away on a conventional loan. So once you get to a 78% loan to value, it would automatically go away. So if you're making your payments for 5, 7, 10 years, whatever, depending on what you put down, there's a schedule that you get up front. So you know what month is going to go away based on your down payment.
And it goes away. You don't have to do anything. You don't have to call anyone.
Correct. And a conventional loan at 78% loan to value, if you just do the normal amortization calendar, the minimum payments, it just naturally goes away. Now, what is interesting is that if the house appreciates, which houses typically do over time, then you can actually get to that 78% loan to value faster than what the schedule is. Like if you're in San Antonio, we've appreciated 6% a year. This year, we're appreciating about 10% this year. So in a matter of 3, 4, 5 years, you might already have the equity, even if you didn't put that extra cash down.
I don't feel like that's something people know.
A lot of people don't know,
I mean,
but it can be done. You know, it's funny. I refinance people sometimes that have had the house for 15 years and they still have mortgage insurance on. I'm like, dude, your house is worth 3 times what your loan is.
Yeah.
You should not have it. So the point is that you can get rid of the mortgage insurance by asking your current servicer to order an appraisal. You have an appraisal. That was going to be my
next question. Yeah.
You have an appraisal fee, and might be $400, $500, $600. But once you pay that appraisal, if it shows that you have that 78% value or less, loan to value or less, then they can get rid of it. Now, they don't have to.
Oh.
People don't realize that. Like just because you have the value doesn't mean the lender will get rid of it. If you're making late payments, things like that, they're going to say no because it protects them.
Got it.
But you can apply for it. Otherwise, you might have to refinance it off. FHA loans have a different way of handling mortgage insurance. Mortgage insurance on an FHA loan has, it's called a split premium.
Is it worth talking about our proprietary product with
yeah,
we
can get into that in a second. Yep.
Okay.
Basic info though for FHA loans, it's split premium. So all that means is that you have mortgage insurance up front that's rolled into loan.
Okay.
And therefore you have a lower monthly mortgage insurance premium. The negative about an FHA loan mortgage insurance premium is if you put less than 10% down, it never goes away.
Less than 10%
down, it never goes away. So unless you refinance or sell the house, you'll always have it, which works for most first-time home buyers. It's typically a first-time home buyer loan. Most first-time home buyers keep a property for 5.5 years.
Right.
It wouldn't have gone away anyways. So it's not that big of a deal. But if you're buying a home and you plan to keep it for 15 years, it might be worth the higher rate for conventional loan with the higher mortgage insurance for conventional loan to have it go away if you're there forever, right?
Yeah.
A VA loan, it works a little bit differently. It doesn't have monthly mortgage insurance, but it has something called a funding fee that's rolled in up front into the loan. That funding fee is less for the first time use. It's more for the second time use. It's different if you're a reservist versus an active duty man. And if you are a disabled vet, there is none. So I said that all quickly. So just talk to a lender about it. But bottom line is you have something rolled into the loan, 2.1, 3.7% rolled in the loan up front and a funding fee, and that allows you to not have a monthly mortgage insurance premium. But it serves the same purpose, right? It's you're paying it all up front in your loan, so you don't have to deal with the cash. Keeps your payment lower, but it ensures the VA that that there's money there in case you did foreclose, right? So all that to be said, there are loans for people like we were talking about proprietary products. We have a loan you can do less than 20% down and not have mortgage insurance.
Right.
It's called lender paid mortgage insurance or upfront mortgage insurance. There are options. It only works if you have a 720 credit score or higher, because you're unlikely to foreclose. That's why they allow you to do it. You choose a little bit higher rate and you don't have mortgage insurance. It's a great option.
Because typically mortgage insurance, I mean, what are we looking at as far as
it's a percentage of the loan amount based on your credit score. So the lower your credit score, the higher it is too, right? So,
but it's a couple $100.
It depends on the sales price, depends on the credit score. But to give you a rough example, on a $200,000 property, really great credit scores, you might be 50 cents on the dollar, so $1,000 a year, so $83 a month. If you have crappy credit scores and you barely qualify, it might be 125 basis points. You might be spending $2,500 a year on mortgage insurance, which is basically $200 a month.
Which is a lot.
It's a lot of money. It's a car payment. It's a car payment. So there are options to get rid of it. There are options to pay attention to it. But that is what mortgage insurance is, and that is different than hazard insurance, which is the question on the table was, what is homeowners insurance? What does it cover?
Right.
Okay. So hazard insurance is it kind of protects you. It really protects the bank too. The reason why it protects the bank is the collateral for the loan is the house. Okay. So banks if you have a mortgage in the United States, you are required to maintain homeowners insurance on the property. Because if you did not have homeowners insurance, then if, God forbid, a lightning bolt strikes your house down and burns down, there's nothing to rebuild the collateral, right?
Right.
So what homeowners insurance for is just like you would think like a car insurance. It, in the event of catastrophic loss, fire, flood, let me not be specific about flood, but fire, water damage, hailstorm, things like that, then they will help fix it. They typically have a deductible, just like you have for your health insurance. Most people choose between $500 or up to a 1% deductible, although there's higher deductibles. If you have more means, you can, self-insure somewhat, right? But if you have a 1% deductible, if you have a $500,000 house, you're paying $5,000 out of pocket before they pay $1, right?
Right.
But it's important to have it for yourself. I believe in insurance. Actually, I have low deductibles because if I'm going to do a claim, I want them to pay everything.
Right.
Otherwise I'll just pay it out of pocket anyways. But homeowners insurance does, you can have it cover contents. You can have it not cover contents. You can have it insure. This is worth looking into with some of our business partners that are insurance agents. Not all homeowners insurance is equal. So just because you have a cheaper product, a cheaper payment, doesn't mean you have the same coverage. For example, there are some insurance coverages that will cover a broken water pipe in your foundation that washes out your foundation, and now you get a structural integrity loss that will cover that. But there's other homeowners insurances that say, hey, dude, it's been leaking for freaking 5 months. This shit's on you. They won't cover that damage.
Yeah.
So you need to really understand what they will and won't cover. Most insurance companies will tell you that they don't cover acts of God. So an act of God or an act of war, that things like that aren't typically covered. And then there's the extra stuff. So the extra stuff, I brought flood specifically. If you're in a flood zone, you need to have flood insurance. Flood insurance would be based on the FEMA flood maps.
And the mortgage, if you get a mortgage, it's required to have it, correct?
If you have a mortgage that's in a FEMA flood zone, yes, it is required. Okay. Now, what's funny is people say, well, I don't need flood insurance because, I'm not in the FEMA flood zone. Well, there's a constant level lake called LBJ that flooded, and it's a constant level lake that doesn't flood, right?
Yeah.
And it took out the bottom 3 feet of lots of houses. The easiest example I would give you is if you are standing in the front door of your house and you look uphill and the street goes up that way and it comes down to you and there's a bend in the street, get flood insurance. There could be water damage eventually. But that's more about understanding water and water drainage. But usually if you're not in a flood zone, it's super inexpensive to have flood insurance. Like $100 or $200 a year. But
if you're in a flood zone, that's when it starts getting pricey,
pretty expensive. Yep. Wind insurance is something people think about at the coast. If you or in Oklahoma. But wind insurance covers different things than flood insurance. It's funny. I own a second home down at Port Aransas, and we're in a lawsuit with our insurance company right now as a condo association because the flood insurance didn't want to pay because they claimed it was wind damage. Oh gosh. Because the wind pushed the water. Think about that. So insurance companies are really rich because they choose not to pay a lot. Be careful who your broker is, be careful who your insurance company is. Look at the claims history. Great company locally in San Antonio, USAA. They're expensive, but they are they cover stuff, right? Yeah. So that's an example. So that's homeowners insurance. The last question was about what is a home warranty.
Home warranty, yeah.
Home warranty is a type of insurance too. I like it for first-time home buyers. I like it for people that do not have a lot of cash reserves.
Yes.
The home warranty companies are the same as insurance companies in that they're all a little bit different. They all cover some things differently. They all have different deductibles based on the plan that you buy. But what's cool is when you buy a house, there is, at least in the Texas contract, the option of the seller providing a home warranty. Or you can buy home warranty even if the seller doesn't buy it. They're between $300 and $1,000, depending on if you have pull equipment, depending on if you have multiple refrigerators, like you have a beer fridge like I do,
right?
Or whatever, whether you've got ice makers or not. But basically what a home warranty does, it covers the mechanicals of your house. So ACs, water heaters, you can opt for covering your washer and dryer.
Yeah, all your appliances.
Appliances, dishwashers, all that stuff, right? Why is it worthwhile for a first-time home buyer, especially if the seller pays for it, if you negotiate it?
Yeah.
It gives you insurance that you don't move in and then a week later your AC goes out and now you've got $8,000 insurance bill.
Which is a big reservation for a lot of people purchasing a house. It's, I don't want to deal with the maintenance of the house. And when I lease or rent, the landlord, it's one call to the landlord, they take care of it. So it comes up quite often as a reason to not purchase.
And the not knowing how to do it or what to do, because my daddy never taught me, is a big thing too. But I love that about home warranties for some people. Again, you don't have extra means to pay for it, because AC bills can literally be $10,000 to replace them.
Yeah.
A water heater, believe it or not, with the new city regulations, can literally be $1,800 to get a full replacement.
Wow!
So it's not cheap to do some of these things. Washers and dryers are the things I hate to buy the most, because yes, you need one, and it's just write a check for $1,000 or whatever you're going to pay.
Yeah. It's like spending money on a garage door. Like, is there anything more boring?
That's funny that you said that. Yeah.
To spend $1,000 on or $1,500 on. Yeah. There just isn't.
On springs. That's actually really funny. I totally agree with that. So let's talk about the home warranties and when not to use them too. So yes, when you're starting out, when you don't have a network, when you don't have the cash, when you don't know how to fix it, yes. And you pay that fee every year. It's an insurance bill, a home warranty bill that comes up every year.
Lump sum, most of them. I don't know.
It's usually $500 a year for as long as you keep it. I also like it for first-time investors for the same reason. If you can work if your cash flow numbers on a property includes like, hey, if I pay $500, it's just one more expense that's not going to hurt my cash flow. Yeah. Especially when you're first starting off. I like that for the first year or two as well.
Because what happens is if something breaks, you call your home warranty company. They send out a service contractor to fix it. They have negotiated prices.
You usually pay $50 for a service call, and it's covered.
And it's covered.
Now, to be quite frank, I do not enjoy working with home warranty companies because they take their sweet ass time.
I've had some phenomenal experiences and some not so phenomenal, but more often than not, the company.
It's good to hear that there's good people in the world. I know some people in the industry that are really great people in that industry. Yeah. I've found that most of the companies, they drag their feet.
The company that we don't have one anymore, our home warranty anymore. But when we did, boy, they took great care of us.
Awesome.
We had really, really, really good experiences every time. And we had a little run there. I mean, everything broke, like everything.
So you got all replaced and then you canceled your home warranty. That's not a bad idea. So the last thing though is like when not to use it. If you can self-insure, and if you have multiple properties, right? So for example, I own, I don't know right this second, let's just call it 10 properties that I own that are rental properties. Well, if the average home warranty is $650 and there's 10 of them I'm paying a year, that's $6,500 a year that I'm paying for home warranties, right? Well, that means that I could buy a brand new AC every year with that check, right? So my point is that if I'm betting on myself a little bit and I'm keeping up with deferred maintenance, so I'm like actually servicing my ACs, I'm actually making sure that my tenants replace the filters and things like that. What I have found is that I've gone multiple years with minimal expenses from a fixing something, water heater, whatever, so that if I have a water heater go out like I just did in shirts last month, I just wrote a check for $1,500, which was only 3 of the home warranties, and I still have 7 that I haven't spent yet, right? Yeah. And the year's almost over. So if you can self-insure a little bit, there's actually a weird fact I just heard. Bill Miller, I believe this is something so secondhand information, but this is interesting and it makes sense. Bill Miller's a barbecue joint here in Texas, and they have like 100 stores. I mean, they're all over the place. They don't have insurance.
Really?
It's cheaper for them to not, like, if it burns down, they'll write a check for it because they have so many locations. They've done the math on it that they literally don't have insurance. They write checks for everything.
Oh, wow.
Is what I was told. And I fact checked it with somebody else and said, yeah, that's true.
Don't they also buy the land?
Yeah, they're a real estate company. They're like McDonald's.
Yeah. So every time they put a new store in,
it's always in a commercial corner, like a badass commercial corner.
And they own the land that it goes on. Yeah.
And that's why that family is, I actually know some of the kids from that family. They're awesome people, but
it's also a fantastic restaurant too.
Yeah, especially breakfast tacos.
Yes, and the soup is really good, but they're also very quick.
Never had the soup.
It's like I would equate it or not equate it. It's very similar to Chick-fil-A. They
That's interesting.
They have their stuff down.
And homegrown here in Texas. Watch that flag.
Like it's
boys.
one that if a restaurant has a line, I'm not waiting in it. But at Bill Miller or Chick-fil-A, I know that they've.
Yep.
So
that's
they're
where
very good.
That's where home insurance comes in. That's where home warranties come in. Thank you for the question. Hope
Yeah.
that answers it.
Absolutely.
And let's rock on with our show.
Let's do.
So, question on the table: when can I spend all the money I've saved? Woo! That's a fun conversation.
Party. Yeah. So this is something I know for sure that I get tripped up on a little bit. You know, we've done all the work and now we're saving money. And it's like, okay, but like when and how do we spend it?
Mm-hmm.
Because I don't know. It's hard to know. And I get tripped up on what account should things come out of and all of that. And if there's a big purchase, is that supposed to come out of like our monthly allotted spending, or is that something that needs to come out of an investment or a money market?
So my basic answer is I don't care where it comes from. The starting point that I actually say is like, if you have a budget, you'll account for it. And that's the first thing that's on the biggest issue is that most people, they don't have a budget in the first place. So they do frivolous spending. They don't account for the frivolous spending. So then when they do the big spending, they're double screwed. But if you're actually budgeting, you start making better choices, you do less frivolous spending, there is more money to go around to do other money. Right, yeah. There is. And so, and it always goes back to you pay yourself first, right? So if you're still addicted to on a monthly basis, you're saving whatever you're saving, then it becomes, or paying down debt, you know, whichever path you're on currently, if you get this framework where, like I'll tell you an example. Where are my shoes? They're there. By the way, I'm all business up top. I've got this nice shirt on, and I am party down below. I've got shorts.
Straight up, I meant to comment. I'm like, yeah, like a real stark contrast.
Yeah, no, I've
here.
got shorts and flip flops on. Now, ask me how old those flip flops are.
How old are your flip flops?
6 years. No, I can afford new fucking flip flops. Let's just be clear. But
well, you probably spent $5,000 on them, so they really should last.
$60.
I can't see the flip flops, so I have no idea what they are.
My Tevas.
Those are definitely 6 years old.
So why do I say that, right? Well, like I find no value and interest in paying for, like I went through that phase. I think some people do. I started buying lots of awesome business suits, lots of awesome shoes, lots of awesome couple $100 belts, you know, all this stuff, right? And then I would grow out of them because I gained weight or I lost weight, and then I had to buy more of it. And then I realized that for me, I get no joy out of it, right?
Yeah.
I got more joy out of saving and building wealth and investing than I got out of. I look in my closet and there's literally 30 suits that I've worn 0 times this year. 0.
Yeah.
You know,
wear suits a lot.
0. And so you go past that and say, well, okay, Josh, well, what do you spend money on? Experiences. I will blow money on experiences all day long. Like,
well, but let's talk about the person that's not the case.
It's the same thing. It is the same concept, right? It's whatever makes you happy, you'll focus in on, because you'll stop doing the stuff that you don't find joy in. So I don't care if you buy a purse. If you really find, like, there's a good friend of mine, my wife's friend, that she collects purses, but she's also been saving for years and years and years. And she allows herself a purse a year. That's a really badass purse, right?
So,
because it's within her budget.
So then my question is, okay, so let's say we want to go on vacation.
Yep.
So it's the best thing to do.
Vacation account.
Starting a vacation account.
Yep. You save it before you spend it.
Save before you go.
What most people do is they just swipe the card and they'll figure it out later.
But okay, so let's say, and let's pretend we're going to go on vacation, and we didn't start a vacation fund. But it's, you know, January rolls around and we're like, oh my gosh, we want to go on a spring break trip. Let's book it. Does it come out of a money market? Does it come out of a...
well, it goes back to...
Because our money market is our float account.
And it depends. For you, it'd be the float account, right? So you're going to use your float account so you don't charge with the credit card. And then the next month, the following month, you pay yourself back. Okay. That's what the float account's for, right? You don't charge it. So we're treating
the vacation like an emergency in that case.
It's your choice, right? Well, I guess mental health and COVID, I would agree that a vacation is an emergency fund.
That's good clarity though.
Yeah.
So I tend to like take things very literally. So the money market, I've been told, is for emergencies.
It is.
So therefore it's off limits until an emergency.
So what are the other options? So let's use an example, right? So you've got the money market float account, you've got your retirement accounts, right? Right. So we could charge it on credit card, bad choice. We could take it out of retirement, bad choice.
Right. It can come out of 401k.
Right. So if those are the two other options, then take it out of cash, right? Do it now. Don't wipe your cash out.
Right.
And it also goes back to, I really firmly believe this, and that's why the money system works for so many different companies. What's his name out of Nashville? Just lost his name.
Dave Ramsey.
Dave Ramsey. Thank you. Dave Ramsey believes in the cash money system. Why does it work? Because when you part with the money, it hurts.
It really
So you
does.
will spend less.
Yeah.
Well, it's the same thing, right? Like if you're used to a $5,000 money market balance for your float account and you just spent $1,000 of it to go book your hotels or whatever, then that you feel that you're going to make a better decision, right? You're not going to go spend all 5,000. That would hurt too bad, right? But not having it feel a visceral pain is the problem. You just say, I can afford it. I'll deal with it later, because it always catches up to you eventually. So, ideally you think proactively. Ideally you think about, okay, I'm going to book a vacation for March of next year. So let's go ahead and set aside an extra $200 a month for the next 6 months. So we have $1,200 to go do a vacation next year, or whatever the number is. Like, you budget for it, right?
Sure.
Because if you're budgeting for it, you're not spending money on the frivolous shit. Like if you look at how easy is it to blow $200 on Amazon stuff and back to school stuff and all this stuff that just kind of flows.
Yeah.
Well, when you're like, it's more important for me to put $200 over here or $500 a month over here for my vacation fund, because I personally will pay for experiences, right? Like I would rather set money over there and not get new shoes, because my eye's on the prize of what I want to do. In fact, I really do believe very firmly on booking out your vacations a year or two in advance. I really believe in that, because it's a reward system that you can look forward to, but you've budgeted for it along the way.
So you could pay for it today, and then, you're not going to go on the vacation until next August.
Yep.
So you can use that money out of your money market account.
Sure.
And then budget or every month put money back in, repay it back into the account. So you are,
again, I'd rather you do it forward thinking and save first, then do it. But listen, nothing's fun about saving everything and not doing. Like this is where, the argument of who's right, Gen X or Gen Z comes in. It's not either. It's the middle, right? Like, meaning saving every dollar and then dying before you ever spend it. That's stupid. Or finally being able to do what you want to do when you're 65. There's no guarantee you're going to have that, and you might not be able to climb Mount Everest when you're 65, right? On the flip side, like cashing in your future for today's experiences is a lack of deferred gratification.
Right.
And it will cost you massively in the future. So I'd rather be moderate from A to Z.
Yeah.
Right. Like I want to save money and I want to spend some money based on what my lifestyle is currently, based on my income is currently. What I see people online doing, and this goes back to my disdain for social media in general, but like you see plenty of people that spend money like a damn rock star that don't have shit in the bank, right?
That's like this is why you cannot compare yourself to anyone else, because you just don't know
it's crazy.
Right. You don't know what anybody's money philosophies are. So you cannot compare yourself.
Right.
And it's easy to look around and go, what am I doing wrong?
Right.
Look them, them. Like, what am I missing?
Well, let me tell you something that I saw the other night that just irritated the crap out of me. Is this kid? Like all kids, everyone younger than me is a kid now, right? So this kid's probably 30. It's not that young of a kid. This kid's 30 years old, and he's not able to buy a house. He doesn't own his house. He rents his house, but he owns a car that's worth $125,000, which is a fucking house, right? So he's got a depreciating asset.
What does he drive?
Doesn't matter. Mercedes.
I feel like it does matter.
It's just a pimped out Mercedes.
I mean,
but $125,000 car that's a depreciating asset, so that he looks cool and can pick up chicks.
Gotta find someone to put a ring on.
Well, he better find a rich girl, because he's got shit in his life and we'll never have it, right?
We could sell his car, I guess.
for 60,000, yeah.
Ow.
Right. So, but that's what we compare ourselves to as Americans, is this crazy spending, kind of.
I mean, what is the payment on that?
If I had to guess,
that is a really
finance over 5 years, you're spending about $1,500 a month.
That's a really expensive car payment.
It's not cheap.
No,
it's actually probably a little more than that. $125, $1,500, $1,800 probably.
Woo.
Depending on what the rate is. But it goes back to like, you can buy a house. So this goes back to an interesting philosophy that like what got me into investing originally was the book by Robert Kiyosaki, Rich Dad Poor Dad, back in like early 2000s. And what he said is, if you want to buy that car or buy anything that you want, like a boat, a car, buy an asset that kicks off enough cash flow to pay for the car. Right. Yeah. So if I want to buy the payment of the payment of $500, let's spend money to invest in a property or something that kicks off $500. So my asset's still appreciating and it's paying for that depreciating asset, but I've still got my original money and it's still growing for me. Right. What a lot of people do is just go spend. And this goes to, the purses only appreciate. I've heard that it's some watches only appreciate. It's like, okay, guns only appreciate.
I had a pair of boots appreciate.
I'm not saying that there's not outliers.
I bought a pair of boots.
I'm not saying there's not outliers. I'm saying it's a poor investment strategy.
But this is crazy though.
Let's hear it.
I bought a pair of boots 2 years ago from Nordstrom. And last fall, they were for sale at Nordstrom for more than I purchased them for. So I'm like, what do you know? Boots can't appreciate value.
So you're going to go sell your used boots for more than you bought them for? Good luck.
I'm going to sell them.
Here's another great philosophy that my love of my life has told me before. So I looked at a bag one time. This is years ago, but she looked at a bag and she's got like the same shirt, 5 different colors, right?
Yeah.
Okay. Apparently this is normal for a woman.
Yeah.
So I was like, honey, how much? Shirt? Yeah, how much do you spend on the shirts? And she told me. She's like, but don't worry, it was a great deal. It was 50% off. So I said, okay, so the shirt was 50% off. So you bought 250% of them. Like you got 5 of them. You spent 2.5 times. I'm happy.
It's better than buying 5 of the same full price shirts.
Okay, we digress.
But it is normal. If you find a shirt that's really good and it works and it fits, absolutely buy it in all the colors. And it's being 50% off is like icing on the cake.
Okay. Pay for it in cash. Don't pay for it in credit because you're not going to be wearing that same shirt in a year for sure.
Oh, yeah.
Right?
Yeah. Don't charge clothes.
I think this goes, there's a couple of different lines we can go down on this. And so I think the best thing is that emotional buying of any kind gets you in trouble. Right? So adding on last minute to do a trip, right? Because you deserve it and you're worn out. Being in a store, seeing something and doing some spending because you're there, bad choice.
Yeah.
When you start adding just a little bit of strategy in your life, just a little bit of looking at the numbers, just a little bit of like, okay, what's my budget? Then you'll pick and choose. Another easy thing to do is just make the money not available. I think we talked about that in a different episode.
Yeah,
but,
that's really important.
Having an online, like I just moved over a lot of money over actually to one of my financial planners to stay in a FDIC insured bank, right? Not because my current Bank of America sucked. It's because if I transferred over to Ron or Eric,
at least you have to call them first.
I have to call them and wait a day.
And
I have to call them and wait a day.
Yeah.
That's it. It's just like, and it's so, we've all heard the thing of your mom or dad might have told you at some point in your life, hey, let's walk away. If you really want it in a week, we'll come back and get it.
Yeah.
And how often does that actually happen? No one goes back and gets it, right? Yeah. So
there's also like the act of having, because Ron is very much like a father figure, and calling and being like,
right,
can you move over $2,000 from my whatever account into my checking? He's like,
very disappointed.
Well, okay.
What are we doing?
What are we doing? It's like, don't ask questions. You don't want to know the answer. Like, don't make me tell you. Don't make me tell you this. But that sometimes is enough to decide against it, because it's like, I literally can't verbalize to Ron what I'm about to do with this.
Yep.
So therefore, it's probably not a great idea.
Yep. Another thing you can do in that vein, by the way, for married couples, pick a number, agree to it up front. Whatever the number is, like make it in alignment with your budget. But like, let's just say it's $100. Like, let's just use average family, $50,000 income. I think San Antonio's median is around 50,000 household income. So let's pick $100. Okay. If one or the other wants to spend $100 on anything, they have to tell the other person.
Yes.
That's it.
I actually do really love
That's
that.
it. It's like, okay. Because then one of the two of you is probably a saver. One of the two of you is probably a spender. but it's going to cause a conversation, hopefully not a conflict.
Yeah.
But it's going to at least make you ask the question, like, do I really want to talk to my wife about this?
Yeah,
right.
For sure.
Like I've got the means and I still asked permission. So I am a gun-toting American here in Texas. And one of the things I do for my ranch is I collect guns. Yes, I do. And I had a moment where I found a gun that I really liked and I could buy it. I still walked away and talked with Christy about it over the weekend.
Very good.
And then I went back on Monday to go buy it. And that's all I'm trying to articulate is
folks.
Even in my family, we have a number that, hey, if you exceed that number, like I want to know about it. Like don't just disrespect your spouse by not like surprise. You know,
because that's a really crappy situation too, and then you just end up in a fight because they'll find out eventually. They'll be in the bank account and see it. They'll the
number of times. And by the way, here's another one where I'll catch up with you, especially if you're using credit cards. I cannot count the number of times that when I'm doing a mortgage, right? So I go through credit debt. And I'm like, okay, it looks like you have an auto payment over at Randolph Brooks. It looks like you have another auto at USA. It looks like you have a credit card at Chase. It looks like you have a credit card at Bank of America. And then somebody says, wait a second, we don't have a credit card at Bank of America.
Say what?
I'm like, looks like it's in, it looks like it's in your name. And it says $12,000 balance, $300. Like, was that paid off? Do you not have any more? And then you hear the wheels screeching.
And they're like,
and one spouse,
they're like trying to look at you.
What are you talking about? You have $12,000 credit card I didn't know about.
Yeah.
I've seen several $100,000 of debt that one spouse didn't know about, right? By the way, let me give a little bit of marriage advice. I officiate a few weddings for some people. Let me give you guys some marriage advice. If you're thinking about getting married, pull the other person's credit before you get married.
I mean, it'd be nice if you could just do a full pre-qualification on
just
them.
Make friends with the mortgage loan officer. Have them do a full rundown and find out hey, if you marry this fool, you're screwed in life.
It is nothing better. And I always laugh because, back in the day when there were single ladies on our team, we're just looking at paper, right? We're just looking at paper and we're like, we got a good one. We got a good job. We got good credit over here. Like this is an eligible bachelor.
Not married, no kids.
Not married, no kids. You know everything.
We know everything about
you have,
Yeah, but it's super sad, super scary. It can risk a marriage. You see people that have hundreds of thousands of dollars of debt that the other spouse doesn't know. And they get so far behind that they realize that they're screwed. They can't dig their way out of it. And they're afraid to tell their spouse because they're afraid of what's going to happen.
Right.
And so
and
it goes back to the
it's like, what's worse when you do tell your spouse?
Right.
Is it the debt or is it that you didn't tell them?
The lie.
I don't know.
That's the lie. It's called a lie of omission.
It just it gets.
But that's the one of those protective things you can do is just, what's the number? Hey, is it $100? Is it $500? I don't care what the number is. Is it $50? But if you're going to spend more than this, you just have to call me first. Right.
Yes. I love that. So the other thing, the other thing I feel like comes up a lot and it confuses me, so it may confuse others, is home improvement stuff.
Oh, good question.
So what's the best way to utilize those? I mean, we want to do some major renovation, a $10,000 renovation in our backyard, or I want to remodel my master bath. I want to put in a deck and outdoor kitchen.
Okay.
Do you pay cash for those things? If so,
great question.
Is that a money market type or float account?
Yeah.
Or do you finance it?
Right.
Like what's the...
So I've got different answers because the first thing you got to understand really is it a want, a need, or an investment? A want, need, or investment. And here's why I say that. Like people kid themselves thinking that by investing in their backyard that they're going to make more money on the sale of the house. And that's not true.
No.
Okay. Yeah.
Outdoor.
There's not a single appraisal that I'm aware of that gave more value to the lawn of the month house over a different house in the neighborhood. So you can put thousands of dollars into fucking shrubbery and plants and never get a dollar back out of it. Right. That's a want. That's a hobby. Okay.
Okay.
Versus we know that in home improvement, bathrooms and kitchens are the two biggest bang for the buck. You typically get more than what the investment is if you're bringing it up to speed. Meaning, if you take old, outdated, bad lighting, bad countertops, bad plumbing, and bring it up to life, new paint, better cabinetry, better appliances, all that stuff, you'll almost always get more than what you put into it out of the kitchen and bathroom space, right? Done right, assuming you have good taste, right?
Yeah.
So that might be looked at as an investment. So, I'd be less picky about money that is discretionary money that will be coming back to you in an example like that, right? A need is a different one, right? So what might be a need? A need would be, and by the way, we don't need to fix up the kitchen if the kitchen works.
A swimming pool because it's hot.
Oh, there you go.
And
that's a great question.
COVID-related issues.
I'm going to ask you, is a pool really a investment, a want, or a need?
I'm gonna say no on the investment.
Okay. So let's go with that first.
Okay.
On average, the best you can expect from a pool is 50 cents on the dollar when you sell the property.
That's higher than I thought. I thought it was 30%.
At best, I said. Yeah. So it's 30 to 50%. 50% is the highest I've seen. So you put $100,000 pool and flat work in the backyard.
Yeah.
It might raise the value 40, 50 grand. So you're exactly right. That is not an investment. Okay. That's like a car.
But so does break even where does that come in? Like if you use it and you're in the house for, 10 or 15 more years and then you sell it, does that make a difference?
It's not an investment. So let's look at that. I mean, I can give you a logical answer that people can argue with me about. If you spend $100,000 in a pool and you swim in the pool 1,000 times, you spend $100 every time you swim in the pool.
Yeah, you gotta swim more.
Right. If you swim in the pool 1,000 times, like that's every day of the year round for 3 straight years. No one does that. Okay.
I would do that.
Of course
I would do that.
Everyone says.
I would do
and
that.
Every pool owner will swim a lot the first year, a little the second year, and they don't even get in their hot tub the third year.
That's why I said that. But I will do it.
So when you really break down, okay, this $100,000 is about $5,000 a use per year for the pool parties. Not a great investment. So let's go there. No. So what do you think is a want or a need?
And how much is the maintenance on a pool?
Great question. If you do it yourself, $50 in chemicals a month.
Okay.
If you have somebody that does pool work, it's $200 a month. If you have a outage and repair, expensive. It's like, you have the heater go out. If you have a pump go out, $1,000 a pop. Now you might have a home warranty.
I was going to say
home warranty might cover
so people with pools
if you add on, like a normal home warranty does not cover pool.
I'm glad you said that. Yeah, because it's not.
Is it like a $500 home warranty or a $1,000 home warranty? So now you're paying $500 a month or something like that, right?
Okay, so investment.
So is it a want or a need? You haven't answered my question. Is a pool a want or a need?
Definitely a want.
Cool. Yep.
I don't know what a need.
Right.
Like how do
it's interesting right now, only because COVID, there's an argument for a need because people don't have the ability to get space and go on vacations like they once did. They're stuck in their space. So more people are using
still kind of dramatic.
It's still a want. Yes.
It's
you're right.
still pretty
That's
dramatic.
right.
Like
a need would be an example of you have a disabled parent moving in. And so now you have to widen doorways. You have to put ramps in. You have to, take out the tub so there's a way to wheel into a shower. Yeah. Like that's a need, right? So when you my whole point in saying this is investment want or need, you prioritize the need. If there's a need, there's a need, right? Like somebody gets paralyzed and you need to you're a 2-story house, you need one of those chairs that goes up and down the stairs. Like that's a need. Yes. So needs, you get it done however you can get it done.
So you can finance it.
That would be probably best done through a home improvement loan or a home equity line of credit loan. Those two are probably the best options. You'll probably be there for a while once you fix that up if it's a need. Right. So you'll probably be there long term. So you're betting on appreciation covering that need cost over time, right? So that would be how I would handle that scenario. If it's a investment, now you need to look at return on investment. Like if you're truly looking at it as an investment, like here's why I'm saying this way.
I feel like want and investment can go hand in hand too.
Nope. Let me explain the difference. So I buy investment properties. Okay. It's a perfect example. Christy and I bought our first investment property. It's a Mamacita house on the west side of San Antonio. That's our little nickname we had for the house. It's tiny little 1,000 square foot house. Somebody died in it, so it smelled really bad. So when we go to rehab it, this is a true story. But she was pregnant, by the way. She was like 8 months pregnant.
The person who died.
So she walked. Christy was not dead. She was the pregnant one. So she walked in 8 months pregnant, and she took one whiff, and she's like, "Nope, peace out, Josh, you're on your own." I was like, "I thought this was gonna be like our HGTV pet project, right?"
Like, here we
she's like, "You're on your own, right?" My point is that when we looked at rehabbing the investment property, and this happens for a lot of people. they fix it up and spend the money to make it the way that they would like to live in the property.
Yes.
So they do all like, everyone's watched HGTV and they want that. A lot of people want that country farmhouse feel, which is expensive. And so they do all this extra stuff that is not necessary. Right?
Not for an investment house.
Especially if it's a rental property.
Yeah.
Right. So you don't spend 3 times what you could, like you could put in hardwood floors because that's what you would like. And those are conversations I was having with Chrissy with this first house of we need granite countertops. We need AB. And it's like, no, like what we need is linoleum because it'll be easier to clean up and it's really cheap. Right. We don't need granite. We just need, basic, we did a tile cover because it looked a little bit nicer, but it was way cheaper.
Yeah.
Appliances, we got used appliances. We didn't get new appliances because that was it was what we were arguing about was the want that wasn't going to give me a really great investment return. The want that she wanted was the look because she wanted to be rehabbed like HGTV, right? Yeah. And there's actually a lot of stories. A lot of people watched that TV show about a decade ago.
So it's more, she was kind of thinking more along the lines of a flip.
Yeah, sure. For sure.
Rather than just a...
But even so, there's a fine line where you can put more money. Like you can put, here's one we were talking about, curtains.
Oh, yeah.
It makes it look prettier. It adds $0 value in the investment. And they're expensive.
Freaking expensive.
So window dressing is an example.
Yeah.
So want and investment are two different things. And so that's why you got to separate in your mind because if it's a investment, like if I'm going to get a return on my dollar, I'll do it all day long. Right? And there's ways to do that, like, in order to protect an investment. An example was we just repainted the outside of our house, not because we wanted to, but because if you don't, and you've got wood siding of any kind, or if you've got stucco, water penetration will decrease the value of your house. So it's protecting the investment, right?
Yeah.
So you figure it out, you get it done. A lot of people do have deferred maintenance that they add up and stack up on themselves because they never take care of what needs to be done to protect the investment.
That's a huge piece.
That's a big problem.
And then you're doing, you're taking cash out of your property. I see a lot of times I see people do cash outs to do the maintenance, to just get caught up, to paint the house, to get the new windows.
My dad gave me great advice about my car. He said, anytime that anything goes wrong in your car, deal with it immediately.
I love you. Because it's
going to be it all sucks fixing a car. $300 repair, no matter what you do,
no matter
at least.
What, yeah.
But you'll do a $300 repair. You're not going to do the 10 $300 repairs. You'll say, screw it, I'll just get a new car. Yeah. But it's way cheaper just to keep up with it than it is to try and do it all at one time. So where do you get the money? If it's an investment, if it's a need, you HELOCs, home improvement loans, some of your cash, if you can't do cash.
You can
cash out refinance would be a great option. If it is a want, you better budget for it. Like only use cash if it's a want.
So a want would be, we want to improve our master bath. We want to put wood floors down in the rest of the rooms. Those are all they're just wants.
Well, the master bath might be an investment, so you can argue on that one.
Okay.
The hardwood floors.
So I have this investment idea.
Right. There you go.
So if it's an investment, then you're saying a HELOC might be an outlet to do that.
Great option.
But then we're just going to have a monthly payment on it.
Right. This goes back to we're budgeting for everything, right?
Yeah.
And it's the same thing with the hardwood floors, right? Like I've been going back and forth for my own house. Like, do I want to do it? Do I not want to do it? It's got to be out of cash. You got to save for it if it's a want, because doing a want on credit of any kind is a bad idea.
It's just bad.
Borrowing more against your house for a want is a bad idea long term. But everyone has their thing, right? So remember I said I'll spend money on experiences, but I'll travel the world to do that. Like I'll go anywhere, anytime with anybody. I love that. That's where I'll spend money. Some people, their house is their castle.
Right.
If they're not going to travel the world, if they don't care about vacations as much, and that discretionary that's been thought out as what's a reasonable amount of my income because I want to live today because we're not guaranteed tomorrow, and I'm going to be in my house every day of my life. Awesome. Just budget for it and pay like cash. But the whole I can do whatever I want, whenever I want, I'll figure it out down the road and we'll mortgage the future. That's what I'm trying to get people to avoid when you think about when do I spend money. It's just take the time to think out a strategy. Is it worth it to you? And if I'm going to do this, what am I going to go without? Make it a weight system. If I do this, what are we not going to do?
Okay.
Right? And I think that that's what's missing from a lot of the youth of America today is it's the live in the moment mentality all day, every day. Although there's a new group I've been looking at now that is actually super thrifty, super minimalistic, and super savers.
Are you talking about the Z's?
Z's.
The Z's are
super minimalistic, super savers.
I haven't done a lot of research on them
Pretty
yet.
interesting. So this is not all younger people. So I get that if you're listening and you're a saver, I'm proud of you. You are the minority. But I think that's the truth for all generations. So I can't say it that way. There's plenty of people my age that live like there's for sure their income will never go away.
Right.
And they're going to spend every dollar as they go. And they will be working when they're 80 if they're still alive. They'll just be working still. There's a reason why there's 80 and 90-year-olds working at Walmart as greeters. I promise you it's not their dream job.
Right.
But they need the extra income to make it work. So does that answer the question? I don't know if we've
I think
covered everything.
So in a nutshell, I think it is if I'm going to remodel my master bathroom, then we need to look. The first idea would be to use money out of a money market, and then repay the money market.
Yep. Which will slow down the process. You won't do all of it at one time.
Right.
One project. You'll do your floors this month. Then you'll do the cabinets next month. And it's not the do it all right now, blow the bank. They'll slow you down. That's the whole point.
Which I think too, if you're going to take a loan out or you're going to put it all on credit, you're absolutely right. It's like, well, while we're in here,
just go ahead and take out an extra 10,000.
Right, like go ahead and do it. Like while we're going to be having our house torn apart, might as well do the floors right now. Might as well go ahead and start in the backyard or whatever. Okay,
what I've always found when that happens, by the way, is you'll have when you're done with that project, you'll find another project.
Yeah.
And like as soon as it's done, like you get really, Twitter paid over your pool for 90 days, and then it's like, hey, what vacation are we going to go on? Yeah. So it's like the constant, what am I going to get? What did I do lately is the problem. So slowing it down is a big deal.
So paying for it, taking the money out of a money market account and paying cash for the project, then repaying that money is the first option or an option. The other next best option would be to truly save proactively.
The first best option is save first. Second one is use cash and pay yourself back.
And then the third
option is don't put on credit. The third option is get a home improvement loan or get a home equity line or do a cash out refinance. If we're talking about home ownership, if that's what we're talking about.
Okay.
I didn't miss out on any spring break trips in college. Those all hit credit cards. So I know there's some people that are like, well, I'm not going to miss out on that deal. It's like, that's perfect. Great. You also don't need to be a bridesmaid that is in 10 weddings in a row that have $500 worth of trips and dresses that you'll never wear again.
I'm so glad I don't have any friends that are like due to get married, because it's like they're doing crazy stuff now. They're doing crazy stuff now.
So you don't have to have 10 best friends. It's okay to have 5.
Just a handful. Just a handful.
Thanks for making me a bridesmaid. Please don't, I'm joking about that a little bit, but it just goes back to, what are you saying no to? What are you actually saying no to?
And then as far as vacations, same thing. I think it's the same thing. So either save for it ahead of time and use that to pay for the trip, or take it out.
Have a specific vacation account. Like when you do a budget, you can line item a vacation account, just move money over $100, $200 a month every month. Set a goal. One thing I've done for 20 years now, it's about time for me to do this. I think I'll do it for my 20th anniversary, I guess. I've never used my points on my credit card I've used for 20 years.
You've mentioned that before.
Yeah, I've got millions of points. So
that's awesome.
For my 20th anniversry, I'll probably go to Europe first class and stay in a badass hotel three.
Yeah.
And not pay $1 for it.
Right.
So there's some deferred gratification for you. And a lot of people, you get their points and they cash out at the end of every year and get their $100. So it's just, but it goes back to just having a plan. Like I've been very clear about what I'm going to do. One day when I can afford to go to Europe first class and stay in a badass house, then I'll use the points. That's what I'm going to use it for.
Yeah.
So things like that, but it goes back to have a plan, follow the plan. You will break the plan every once in a while, but you've got a better outcome than people winging it. And that's the overall thought about investments. Don't wing it.
Don't wing it.
Have a plan. It's about, you're saving anything. Don't wing it. Have a plan. Paying down debt. Don't wing it. Have a plan. Spending is the starting point. Yeah. That's what this question's about. Don't wing it. Have a plan about your spending. It's okay to budget yourself and reward yourself as you go. The nice dinner out, the nice watch every year, the nice purse if that's what you're into, the nice That's cool.
Yeah.
But have a plan for when you're going to do it. Don't do it in the moment.
Don't do it in the moment.
So the plan might be as simple as, if it's over $100, I'm going to call my wifey. I have to leave at least 24 hours before I buy something that I find. I am only allowed to do over $100 spending once every 2 months, if that's your number, for frivolous stuff. I'm going to create a separate vacation account that I'm going to put $300 a month into. And as long as we don't go on vacation, whatever's in there, we can blow that, period.
Yeah.
And I don't feel bad. I get about spending my $12 a drink at the J-Dub or whatever.
Absolutely.
You know, so
that's the best part.
But it just goes down to just having that plan removes so much stress from it, because what you don't want to do, and I think it's probably why you even brought this topic up, is people will not follow a budget long term if they feel controlled, and if they feel like I'm working
to save
I'm living to work, not working to live.
Well, and
right?
if one of the benefits of budgeting and saving and working so hard and doing all these things is so that you can do the things that you enjoy, and you can
have options.
You can have options. And if you want to improve your house, you can. If you want to go shopping, you want to go on vacation. And so when you get caught up in, I don't even really know where it's all, there's a sense that it's all gone. Because it's all tucked away places.
Yeah,
and that you can't touch
my favorite thing to tell money students is money buys you options. Failure to exercise your options makes you stupid. Money buys you options. Failure to exercise your options makes you stupid. So as you amass wealth, little bit, lot bit, doesn't matter. As you do it, everyone struggles with the same issue, right? The point is that whether it buys you time, whether it buys you that cool thing you always wanted. Like, I'll give you a shout out to Hunter Markwart. Hunter Markwart's birthday's today.
Oh, happy birthday.
And this guy is a high income earner and has been for years. And he's having a big birthday today. And he bought himself a 1956, what was it? Lincoln. 1950 is a badass.
Nice.
Like, it's a badass thing. And I said, hey, out of curiosity, how long have you wanted that? And he's like, I've wanted this car for 20 years.
20 years. Exactly.
Right? So, like, that's good
cool.
for you, buddy. Like, you did it. You've earned it. You've saved. He could retire today. And he finally gave himself permission to buy himself a badass car for his birthday, right? And so he could have waited 5 more years, and he could have died in 4.
Yeah.
So we have to live as we go and go on those vacations and do those cool things. But just make sure it's worth it. Like
I think the longer you can talk about it and plan it, because again, going back to like when it's impulsive, that's where the regret comes in. I mean, it really
how many times have you bought an outfit at a store and like it hung for a week or 2, and then you're like, I need to take this back. Back. Right? Like, people have buyer's remorse for a reason.
Yeah.
It's not because it was the right decision in the first place. But if you leave and then you come back, well, you're probably close to the right track.
Yeah.
Because you had to think about it and justify it and all that fun stuff. But I hope this was helpful for you.
It was absolutely helpful. Yeah.
It's one of those things that, just remember, money shows are not just about making money and saving money. Like, it's about living.
Yes.
Like, I just want people, and why we started this project in the first place is to try to teach people that there is a better way and a better future, and it doesn't mean it's instead of enjoying your life along the way too, right? Like, I would argue that you're having more fun with your cooking habits with your family right now, spending less money in the kitchen, versus going out than ever before. Budget wise, you're getting better, I'm getting better, and we're still doing awesome, fun stuff.
Yeah, and I think in the for so long, my idea of saving was not spending. And that leads to burnout. There's zero fun in that.
Yep.
There is zero fun in that. Yep. And so, just allotting yourself money in different areas and then doing the things that you want to do, right? And being able to take the vacation and improve the house. And it feels even better because it's been done responsibly and that this vacation is not something you shouldn't be doing because it's...
And the whole key here is, when can I spend money? It's when you have the money to spend, right? Like, spending money that you don't have the ability to pay back on credit compounds the problem.
Yeah.
Compounds the problem. And if you think you felt bad because you missed out on that vacation when everyone else went, try being in debt up to your eyeballs for 10 years in a row and fighting to breathe.
That's heavy.
That feeling is way worse over 10 years than missing out on that one trip that you wish you'd gone on with
I
all
mean,
your,
it really is.
and
Because
people don't think that way.
the other thing that I think is really important, and I have to check myself on this, and I've had to in the past, is there was about 2 years ago, 2 years ago, we were planning on going to Hawaii for our anniversary and just all this stuff. Some things happened. What was the summer it was the first summer when Weston had diabetes, and it just wasn't realistic. You know, I mean, it wasn't a good time. We had additional expenses that we had started, getting into. So it didn't happen. And I was real pissy about it for a little bit because I was just pissy about it. Made me mad. And I felt sorry for myself. And so in its place, we ended up doing something just that was very reasonable and that would keep Weston safe and all of that stuff.
Right.
And we just went up to my brother's house and we packed the week full of Rangers games and, just all sorts of stuff. And we had a great time. And I really had to stop and reflect and say, it's really, really not about anything other than who you're spending the time with.
Yep.
Are you getting that quality time? And that can be done literally anywhere.
Go camping.
Go camping, right? I mean, take a road trip, so it can be done anywhere. So I really had to kind of it was just a good moment for me to say, you know what, it really doesn't matter that we're not in Hawaii because I'm with my family. We're having a great time and making great memories. And
what you just described is just being grounded in gratitude too.
Yeah.
Like stop worrying about what you don't have, start being appreciative of what you do.
Absolutely.
And I know that people's family situations are different and financial situations are different. And sometimes it's really hard to find the gratitude in the moment. Start with health.
Start with
the health of your family and friends. Start there and then work out. But being really grounded in gratitude allows you to make better choices for yourself and for your family.
And find the beauty in whatever you have in front of you.
Absolutely.
Whatever your situation looks like, if it's a road trip or whatever, if it's not going anywhere, stay at your house and do things differently than you normally do. And that's your vacation. Like you gotta get creative. You gotta get creative. So anyways, I thought this was awesome. Stay tuned to what I do with my house.
Yeah. And if you have any questions or comments, please reach out to us. Please like, share, subscribe, and we'll see you next time on Sigman Sense.
Peace out.
Bye-bye.